All of the research and all of the returns show that you can't time the market in alternatives, especially. You should just stay invested. So we strongly believe you stay diversified and you stay invested through cycles.
So really the advantage and the disadvantage of private markets is the illiquidity. You need to stay invested through the crisis because the underlying GPs are going to decide when to deploy capital and when to hold on to capital. The good news is that you've got somebody who's closer to the markets than you as an institutional investor making those decisions, both on when to deploy, but also when to get out.
One of the things we've been able to determine doing some recent research is that really a slow and steady approach to investing in private equity has been quite beneficial. So when you try to time the market, get too tricky about making your allocations to private equity funds, it turns out to not provide much advantage. Even if you had perfect foresight, it can look forward and say, I just want to invest in, say, the best half of vintage years. That outperformance really isn't that large. The reason for this is it's a little subtle. It's well known to people that are in these markets, but when you make a commitment to a fund, you're not putting the money to work right away. You're saying, hey, private equity fund, you have 5 years to go find investments and put my money to work. So you're really delegating much of that timing decision. This is very different than trying to go in and out of public markets, which is feasible, difficult, but feasible. But in private equity, much of the ability to do the timing isn't even the investors.
Leverage is a big point that I'm concerned about, so we are focusing on strategies that are either lower levered or use leverage in a way that is matched with the investment horizon.
You know, one of the places where we've allocated is distressed or special situations managers. Those managers have underperformed, I'd say, more recently relative to their buyout counterparts, but then during periods of market correction, they tend to perform better. And so we really believe in building a portfolio that's really appropriate for all seasons and having that different exposure mix to help you think about, you know, the different types of market environments that you have.